Breaking news: if you've got £11,600 or more sitting in your bank account, it might be time to take a closer look at your finances because HMRC could be knocking on your door. That's right, thousands of savers across the UK may unknowingly be liable for tax on the interest they're earning, and it's catching many people off guard. Whether you're diligently building a rainy day fund or letting your savings quietly accumulate in a high-interest account, you could be crossing a threshold that triggers a tax obligation and not even realize it. So what's changed, and why is HMRC now sending out warnings? The answer lies in something many people overlook: the way interest from your savings is taxed. Alice Hayne, a personal finance expert at Best Invest by Evelyn Partners, has shed some light on the matter. She explains that your liability for tax doesn't just depend on the amount you've saved, but also on the interest rate your account offers and even how frequently that interest is paid, whether monthly or annually. With interest rates on savings accounts seeing a rise in recent months, more people are finding themselves breaching their tax-free allowance without even knowing it. Let's break it down. If you're a higher rate taxpayer, meaning you're earning over £50,270 per year, your personal savings allowance is just £500. That means you can earn £500 in interest from your savings before HMRC expects a cut. And here's where it gets tricky: at a rate of 4.31%, a competitive interest rate by today's standards, you only need to have around £11,600 in your account to hit that threshold. Any interest earned beyond that amount is subject to tax. For example, if you have £20,000 saved at that rate, you could be earning nearly £862 a year in interest. That's £362 over your allowance and taxable. Now, if you're a basic rate taxpayer, earning under that £50,270 threshold, your situation is a bit more forgiving. You have a £1,000 personal savings allowance, which means you can earn more interest before paying tax. Using the same 4.31% rate, you could theoretically hold up to £23,200 before your interest tips you over the allowance. That may sound like a lot, but with many savers spreading funds across multiple high-interest accounts, that line is easier to cross than you might think, especially if you're using savings platforms or switching accounts regularly to chase better returns. Even those with modest incomes and relatively average savings balances are being affected. With the financial climate encouraging people to save more for emergencies and future goals, hitting the tax threshold is becoming surprisingly common. It's also worth noting that these allowances haven't risen with inflation or with changes in interest rates, making it more likely that average savers will tip over the line. But don't panic, there are smart ways to manage this and keep more of your money in your pocket. Alice Hayne recommends using individual savings accounts, or ISAs, to your advantage. Every UK adult gets an ISA allowance of £20,000 per year. And it doesn't matter whether you use that for a cash ISA or a stocks and shares ISA, it's tax-free. So, if you're earning interest or investment gains within an ISA, none of that counts toward your personal savings allowance. This gives savers a huge opportunity to legally shield more of their returns from tax. Want to get strategic? A clever approach would be to split your savings between different types of ISAs. For example, keep part of your emergency fund in a cash ISA with the best rate you can find, while using a stocks and shares ISA for long-term growth. While the latter carries more risk, it also offers the potential for higher returns over time, and all of it remains tax-free, regardless of how much you earn. Now, here's a tip for those hovering just above the higher rate income threshold. If you earn slightly more than £50,270 and have found yourself slipping into the 40% tax band, there's a potential workaround: salary sacrifice. This arrangement allows you to reduce your taxable income by diverting a portion of your salary into your pension. Not only does this bring your income back under the higher rate threshold, potentially doubling your savings allowance back to £1,000, but it also boosts your pension contributions, helping you build a more secure retirement. And there's more: salary sacrifice not only helps with tax efficiency but also increases your take-home pay in the long run by reducing your national insurance contributions. In other words, you benefit today and tomorrow. However, before you jump on this, it's essential to understand the trade-offs. Reducing your salary might affect your eligibility for credit, like mortgage applications, since lenders often look at your gross income when assessing affordability. Plus, your employee benefits, things like life cover, sick pay, holiday entitlements, and maternity leave are often calculated based on your salary as well. That's why it's crucial to speak to your HR department or financial advisor to get a personalized breakdown of how salary sacrifice might affect your overall financial position. There's also the issue of how interest is applied. If your savings account compounds monthly, the accrued interest could grow more quickly than anticipated, especially if you're regularly depositing into the account. This might sound like a good thing, and it is, but it also increases the risk of unintentionally exceeding your tax-free allowance. People often assume that only large sums of money are taxable, but in today's high-interest environment, even moderate savings can result in surprising tax liabilities. Another often overlooked scenario is the use of joint savings accounts. If a couple holds a joint account, the interest earned is typically split evenly between both account holders. This could work in your favor if only one of you is a higher rate taxpayer. For instance, if your partner is a basic rate taxpayer, you might consider moving a larger portion of your savings into an account under their name to maximize the allowance and minimize your tax liability. Of course, this requires a high level of trust, so it's not a one-size-fits-all solution, but it's worth considering in certain circumstances. And don't forget the self-assessment angle. If you do end up earning more interest than your allowance permits, you'll likely need to inform HMRC and file a self-assessment tax return. This is another area where many people slip up because the banks don't always deduct this tax automatically, leaving it up to you to report and pay what you owe. Ignoring this step can lead to penalties and interest charges, even if the tax amount is relatively small. So it's important to stay informed and keep your records accurate. So what should you do now? First, take stock of your total savings and where they're held. Check the interest rates and calculate how much interest you're likely to earn over the course of the year. If you're anywhere near the £500 or £1,000 personal savings allowance thresholds, you need to act. Look into transferring funds into ISAs, consider salary sacrifice if you're near the higher rate threshold, and think about how your savings strategy fits into your broader financial goals. And don't just set it and forget it. Keep reviewing your finances regularly, especially when interest rates change or when you get a pay rise. Financial literacy is key. Many people are missing out on tax saving opportunities simply because they don't understand how the rules work. With inflation, rising living costs, and economic uncertainty, every pound counts more than ever. So the more you can keep in your pocket legally, the better. Also, don't underestimate the impact of tax on long-term savings. That little bit of interest being taxed each year can really add up over time, especially if you're saving for a home deposit, your children's future, or retirement. By using tools like ISA transfers, high-yield savings accounts, and careful income planning, you can protect your money and make it work harder for you. The takeaway? Tax on savings is no longer a concern only for the wealthy. With rates climbing and thresholds staying the same, everyday savers are now facing tax bills that were once unthinkable. Understanding how to legally minimize your liability isn't just smart, it's essential. In conclusion, HMRC isn't out to punish savers, but it does expect people to be aware of the tax rules surrounding interest earnings. And now, with more people earning higher returns on their savings thanks to improved rates, it's more important than ever to stay informed. Whether you're a seasoned saver or just starting out, don't let tax rules eat away at your hard-earned interest. Take control, plan wisely, and make use of the legal tools available to you. And that wraps up today's important update. If you found this video helpful, don't forget to hit that like button, share it with your friends and family, and most importantly, subscribe to the channel for more smart money tips and breaking financial news that directly affects you. Stay informed, stay ahead, and as always, thanks for watching.